a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about small cap stocks and ETFs, which are in focus these days. So last week, all major indexes hit new record highs after the Fed announced a 25 basis point interest rate cut and signaled more rate cuts ahead. For the small cap Russell 2000 index, it was the first closing record high in almost 4 years. And we know that the stock market has largely been driven by mega cap stocks. And in fact, over the past 10 years, the S&P 500 index has gained about 302%, which is more than double the Russell 2000's 142% return. And that outperformance has in fact widened in recent years as AI optimism supercharged the mega cap rally. And small cap stocks have been largely overlooked by investors despite their attractive valuations. And earlier this year, in fact, late last year, these small caps had rallied after President Trump's elections because these domestically focused companies, they were expected to benefit from tax cuts and deregulation. But these companies have struggled earlier this year because of tariff-related uncertainty. Last month, small and mid-cap companies, they led the market rally, and the Russell 2000, in fact, surged 7% in August. Still, many experts, they remain skeptical about whether this rally can continue, and we don't know whether it is a start of a sustainable trend or just another head fake like those we have seen in recent years. And in fact, after the recent underperformance over the past 10 or more years, the valuations look quite attractive. The Russell 2000 currently has a P/E ratio of 18.9, whereas the S&P 500 index is trading with a P/E of 29.9 times. Now, larger companies do deserve a higher multiple because they are more profitable. So that is something investors should remember. Now, why the recent outperformance, particularly in August? Because these companies are sensitive to interest rates. They often carry higher debt burdens and very frequently with floating interest rates, which makes them very sensitive to interest rate changes. They also tend to lack access to the bond market. In contrast, mega cap companies, they hold large cash reserves, and many mega cap companies had already refinanced their bonds to lock in low rates before the Fed had begun raising rates in 2022. Now, as the Fed is expected to cut rates several more times in the coming months, these companies should benefit. But at the same time, they are dependent on continued economic growth. So if you expect the economy to slow down, then small caps will not do well. And if the economy slips into a recession, then investors are, of course, more likely to go back to larger, more stable, more cash-rich companies. Now, there are two small cap ETFs which are quite popular. And those are the indexes that these two most popular ETFs, small cap ETFs, also track. The iShares Score S&P Small Cap Index, that ETF is up about 923% since its inception in May of 2000, whereas the iShares Russell 2000 ETF IWM, which tracks the Russell 2000 index, that is up about 640% over the same period. So significant difference in performance. This is the chart which shows the difference in performance. And according to a study by S&P Dow Jones, this is mainly due to a profitability requirement built in the S&P 600 index. So profitable companies means stronger performance. That is because almost 40% of Russell 2000 companies are unprofitable. And further, when these Russell indexes are reconstituted, they sell their strongest performance. So strong performers from the Russell 2000 index are promoted to the large cap Russell 1000, whereas underperformers in the Russell 1000 index are demoted, they are moved down. And then these ETFs, they are forced to sell winners and buy losers. That is the main reason why we have seen this huge difference in performance of these two ETFs, the most popular small cap ETFs, IJR versus IWM. Now, these small cap ETFs, small cap stocks, they tend to receive little or no analyst coverage. So for most investors, it is difficult to make stock selection, to pick stocks. So that is why ETFs are a better way to get exposure to small cap stocks. And let's take a look at 4 ETFs, which are quite different from one another. Now, obviously, let's start with the iShares Core S&P small cap ETF, IJR, which tracks the S&P small cap 600 index. And it is now the largest small cap ETF. And as the name suggests, it tracks 600 stocks, has 86 billion in assets and an expense ratio of 6 basis points. Let's go to the quote page on Zacks.com. You can read our research report articles. Then using the link, you can go to the iShares webpage for this ETF. And let's take a look at the holdings. This is up 4.6% year to date, has an expense ratio, ultra cheap expense ratio of just 6 basis points. Let's take a look at the holdings. So Sandix, Mr. Cooper, Sterling Infrastructure, these are the top holdings in the ETF currently. Now, the second most popular ETF is IWM, which is the Russell 2000 ETF, and this tracks the popular Russell 2000 index. And as the name suggests, this has about 2,000 stocks. This is also quite large with 70 billion in AUM. And this is slightly more expensive, 19 basis points expense ratio. Let's again go to the quote page on Zacks.com. And again, you can go to iShares webpage. Now, I had shown a chart which showed how IJR had outperformed the IWM ETF over the longer term, more than 25 years. But this year, IWM has done better. And the reason is some of its holdings, which have been driving the outperformance. Credo Technology, this is the top holding. IonQ, Bloom Energy, Oklo. Now, these are some of the stocks that have benefited from either the AI boom, or these are quantum computing stocks or nuclear energy related stocks, which have done quite well. In fact, on the Zacks quote page for the ETF, if you look at the holdings, you will see that how some of these companies have done so well over the past year. And that is why the Russell 2000 ETF is up almost 12% this year, outperforming IJR. Now, the third ETF which I'm highlighting is one of the best performers lately. And in full disclosure, I own it in the ETF portfolio that I manage, ETF investor portfolio. So this is Invesco S&P Small Cap Momentum ETF. This selects 120 securities in the S&P Small Cap 600 index with the highest momentum scores, has 1.9 billion in assets and 39 basis points expense ratio. Let's take a look at this ETF by going to the quote page on Invesco. And if you look at the portfolio, you will see Mr. Cooper, Sterling Infrastructure, Interdigital. These are the top holdings in this ETF. And if you are interested mainly in selecting small cap stocks that are profitable and have favorable growth prospects, then maybe you can look at this particular ETF. And this has also done quite well. Victory Shares Small Cap Free Cash Flow ETF. So this aims to select 200 profitable small cap companies by looking at high free cash flow yields and favorable growth prospects. This is relatively new, has 357 million in assets currently, and this is a bit pricey. 47 basis points in expense ratio. And again, let's go to the quote page and see what it holds so you can learn more about the methodology, etc., and look at the portfolio. So Lyft, Core Natural Resources, Crescent Energy, Zaz Pharma, these are the top holdings in this ETF. Now, on the last slide, I have the comparative performance of the 4 ETFs that we talked about versus the S&P 500 index over the past year. So over the past year, the S&P 500 index is up about 20%. XSMO, the Invesco product, is up about 14%. And IWM and VFlow both are up about 12%. And I discussed the reason why IWM has done better than IJR. IJR is up about 6% over the past year. Thanks for watching. Make sure to check out Saks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.